So most people don't know this, but most of the wealth held by billionaires is not taxed. And I'm about to show you how to accomplish the same thing with the buy, borrow, die tax strategy. So check this. Most Americans pay more taxes as they accumulate more wealth, whereas many billionaires pay less taxes as their wealth skyrockets. Some of the wealthiest individuals are able to pay almost 0% of their income towards taxes, while everyone else pays up to 37% of their income towards the same taxes. So how is this possible? Well, it all starts with understanding how your wealth is taxed, and it's actually quite simple. Your income is taxed. Therefore, if you can avoid income, you can avoid taxes. When you buy assets that grow in value, it is not income. When you borrow money against your assets, it is not income. When you die, the transfer of your assets to your heirs is not income. On the other hand, when you sell assets, it is considered income. Or when you earn wages, it is considered income. The buy, borrow, die tax strategy allows you to build wealth, get cash when you need it, avoid paying taxes, and pass generational wealth down to your heirs tax-free. And as a licensed CPA that helps people save on taxes every day at mycpacoach.com, I am going to walk you through this entire process in 3 easy to follow steps. So let's go ahead and jump in. Step number 1, buy assets that appreciate in value. This may be stocks, real estate, life insurance policies with a cash value component, or even a business that you want to start or buy. But whatever it is, it needs to be an appreciating asset. And here is why. When your assets rise in value, 2 things happen. Number 1, your wealth increases as your assets appreciate. Probably already know that your assets minus your liabilities equals your net worth. So as your assets appreciate, so does your net worth and your wealth. And number 2, you pay no taxes on the appreciation of your assets when you hold them. Or in other words, if you do not sell your assets, you will never pay taxes. This is why the ultra wealthy have over $8.5 trillion in unrealized capital gains. They own assets, they never sell them, and they use them as leverage to fund their lifestyle and future investments. And when they do earn taxable income, they try to report as little of it as possible. Some CEOs literally take a $1 salary from their companies while building millions, if not billions, in wealth. Instead, they choose to benefit from their assets, their equity, or shares they own in their own companies. And as their portfolios increases in value, so does their wealth. And this strategy allows them to do this while paying very little to no taxes. And guess what? You can start working towards this as well by simply buying assets and building your portfolio. And ideally, you want to buy assets that you can hold for the long term, like low-cost index funds, for example. Or other people may be better suited in building equity through their business or real estate ventures, for example. Look, there's different strokes for different folks, but the bottom line is that you must have assets in order to use this strategy. Then you can leverage those assets, which is the next step. Step number 2, borrow against your assets. So when you need money from your investments, you really only have 2 options. Option number 1, you can sell your assets and pay taxes on the gain. Or option 2, you can borrow against your assets and pay no taxes. Now, borrowing against your assets is very attractive for several reasons, so let's talk about it. Number 1, your loan proceeds are not considered income, so anyone who does not want to pay taxes will benefit from this. Number 2, by borrowing instead of selling your assets, you can keep your assets invested. This prevents you from interrupting the potential growth of your investment. To illustrate this, just look at this example from JP Morgan. Let's say you had a $10 million portfolio and needed $3 million for whatever reason. Well, if you sold your investment for that amount, you would have less money invested, bringing your total return to $483,000. Whereas on the other hand, if you simply borrowed against your portfolio for the same amount, like client B, you would have more money invested, which would allow you to have more returns. In this scenario, the total return increases by $148,000. But wait, that's not it. The benefits get even better. Number 3, you can also invest the proceeds you borrow, or in other words, you can borrow against your assets to buy more assets. Some people call this double dipping because this basically allows you to use the same amount of money in 2 different ways. For example, if you have $100,000 worth of stocks, you could take a $50,000 loan against it to buy $50,000 of more stocks. So instead of having $100,000 working for you, you would have $150,000 of capital working for you. We also see people do this a lot with real estate. They will buy one property, build equity in it, and then borrow against it to buy another property. Or people do it with their business. You can buy one business, build the value and the equity, borrow against it, and buy more businesses. And finally, let's talk about one of my favorite benefits. Number 4, you can write off the interest expense on your loan. You do not get a tax write-off when you pay income taxes, but you do get a tax write-off when you pay interest expense on your loans. Usually, when you borrow money against your assets, you do still have to pay interest on the loan. But if you are using your loan proceeds to make other investments, then the expense may be tax deductible, which means it can then be used to offset other income you report on your tax return. For example, in 2007, it was reported that Jeff Bezos earned $46 billion in income, but he was able to offset, quote, every penny of it with various losses and deductions like interest expense. So yes, when you borrow against your assets, you do need to consider your interest rate and your interest expense. But more importantly, you should consider the after-tax impact of your interest expense. If incurring interest expense means you can keep your money invested for longer, you can make additional investments, you can avoid selling and paying capital gains taxes, and it can offset other income on your tax return, then it may very well be worth the expense. Now, to be fair, whenever you borrow money, there is a level of risk involved. For example, if your portfolio drops in value, then you may have to suddenly repay the loan or risk losing your collateral, which would be your assets. So obviously, anyone considering this needs to carefully evaluate the risks, the costs involved, and the potential consequences. With all of that said, how exactly do you go about borrowing against your assets? It's actually quite simple and simply depends on the type of assets you own. So take note of these tools that you can use. So if you have a brokerage account where you invest in stocks, bonds, and similar securities, you can use a securities-backed line of credit, also known as a SBLOC, or portfolio loan. You can also take advantage of something called a margin loan if you're specifically wanting to use the money to buy more securities. Now, if you own real estate, you can use a home equity line of credit or a HELOC. And if you own a business, you can also use a business line of credit or secured loan. You can also do something similar with life insurance policies. So typically, you can borrow against permanent life insurance policies that have a cash value component. Basically, under this structure, a portion of your premiums are allocated to your policy's cash value. And once it reaches a certain amount, your insurer may allow you to borrow from it. And when you do, the proceeds are free of tax. Now, as good as this sounds, we are not done with this strategy yet. There are even more tax benefits to consider when your assets transfer over to your heirs, so let's talk about it. Step number 3, die. So when you die, someone will inherit your assets. And when they do, 2 things may happen. Number 1, your heirs will receive the assets at its fair market value, not what you paid for it. So this basically wipes out your entire capital gain. For example, let's say you spent $100,000 to acquire assets and it's worth $1 million when you die. Well, if you sell it while you are alive, you would have a $900,000 capital gain. But by now, you should know that you should never sell your assets under this strategy. So let's say you did not sell and you died with your assets and your heirs then received $1 million. And let's say they sell it immediately for $1 million. Well, in that case, they will pay 0 taxes because of something called step-up basis. So your basis in the asset is the cost you paid for it. But that basis does not transfer to your heirs. Instead, the assets they inherit are valued at fair market value at the time of your death. So I say all of that to say, if you never sell your assets, not only will you never pay taxes on it, but your heirs will probably not either. But what about estate tax? Well, there are ways to avoid that too. Well, for starters, estate tax does not apply to most people. It's only assessed on amounts over 13 million for single taxpayers and 27 million for married taxpayers at the time of this video. So if you're not passing down that amount, you won't have to worry about this anyway. At least on a federal level, some states vary. But let's say you are subject to estate tax. What do you do then? Well, in that case, you may still be able to avoid estate tax through using various types of trusts, usually some type of irrevocable trust. So the real question is would you really do the buy, borrow, die strategy? Talk to me in the comments below. Personally, I have more peace of mind when I don't take on more debt, but I also recognize how beneficial it can be from a tax perspective and a wealth perspective, so I'd be curious to know your thoughts. Also, if you want a tax plan that covers everything that you need to do from a tax perspective, just apply to work with one of my CPAs today at mycpacoach.com.